A group of super rich investors have just increased their cash position. Is this the correct strategy to take with the market at all-time highs? Stay tuned for more. Thank you for watching. This is Richard with Wisdom Investor. We're going to take a look at some of our technical indicators and try to get an idea, is this the time to increase cash position, or is the market going to continue higher? We're going to look at some of the reasons why the market continues to move higher. We're also going to look at some technical indicators that are giving us some warning signs. Here's an article. These super rich investors just raised cash to record levels to hedge against the greatest period of unknown. This article goes on to say, Tiger 21, a group of 800 plus investors averaging more than 100 million in assets each, say they're sitting on a record cash pile representing 19% of their holdings. That's a spike from the 12% level where the figure had been for the past few quarters. It goes on to say members are deeply concerned about the gap between the Wall Street and Main Street and are therefore acting defensively to keep cash balances high. The question is here, is this the right approach to take to increase your cash holdings? Now, I think there's several reasons why the market continues to go higher. One, we've got low interest rates. The Fed continues to juice the market. And also, we have a lot of investors that are shorting the market, thinking the market should come back down. So one of the biggest stocks here right now that's being shorted is Apple Computer. Every time this market goes higher, short players come into the market here. Last week there was near 24% of the shares being shorted in Apple Computer. So every time the shares continue to go higher, those shorts give up their short positions, which causes more buying to come into the market. Now, there is a reason to think about shorting the Apple Computer. It's been on a skyrocket to the upside, and eventually there is going to be some selling. It's just a matter of when. Now let's take a look at the other side of things here. Right now, the put-call ratio is at some of the lowest levels that it's been. Typically, when there's a lot of selling in the market, the put-call ratio peaks out at the highs. You can see here back in March, when we had all the selling in the market, the put-call ratio was at its highest. And if we compare that to the S&P 500, you can see the drop in the market. Also back in December of 2018, we had a heavy sell-off, and you can see how the put-call ratio peaked here. Now on the inverse here, as we look at the S&P 500, you can see when we reach these peaks in the market, the put-call ratio hits some lows. Right now, we're near the lows in the put-call ratio. That's telling us that there may be a vacuum forming underneath the market. We're not seeing quite as many short sellers for the entire market. Again, Apple has a high number of short sellers, and Apple itself seemed to be pulling the market higher. Here's a look at Apple on a longer term here, and you can see we're getting this massive blow off top here as a possibility. Also, a lot of investors came in to buy Apple shares before the stock split. That created some of this, what I'm calling a possible blow off top. Eventually, it is going to turn around. There's going to be profit taking. It's just a matter of when. So those super rich investors, they could be on the right side of the market by increasing their cash positions right now. Here's the IBM Russell 2000 Small Caps Index. We're still not breaking out to the high side in these small caps. Typically, when the market wants to move higher, the small caps are going to participate, and they're not participating at this time. Let's look at our S&P 500 trend indicator here. We're showing this trend indicator starting to move to the downside, even though the price is moving higher. That's a negative divergence here. Price is moving higher, indicators pointing lower. Again, Apple's in the S&P 500, as well as other technical stocks. Those stocks are pushing this higher. Let's look at the rest of this trend indicator here. Stocks above the 200-day moving average we're starting to show some weakness. Even though the price is at the highs, number of stocks above the 200-day moving average is declining by ever so much. Let's look at the advanced decline percent. Again, we're showing some divergence between the price and the advanced decline. Number of stocks above the 50-day moving average, again, showing some divergence. Let's take a look at gold, what's going on with gold. We did have a peak of the price on gold over 2,075. Since then, it's backed off. We're showing some support levels. The seasonality for gold does seem to show some weakness over the last 20 years going into September and October. So looking at the gold chart, we might get some more basing here. I'm not necessarily saying we're going to be dropping lower on the price of gold, but we could get some more basing action. If we did get a move back to, say, the 1800 level, somewhere in that area, that could be a good buying point for gold again. With the dropping of the interest rates moving lower, the US dollar has also been moving lower. Many saying that's one of the reasons gold has been moving higher, but we are showing some basing action in the US dollar. So there's possibility we could get some action to the upside here for the dollar. That could be further weakness for gold. And the price of oil continues to be steady here, much higher off of the lows back in April. Back to our original question here, is this a time to raise cash? I think this is a time to be concerned. I would not be buying into the market at this time. Dollar cost averaging is probably the best approach because we don't know exactly when some type of a sell-off, but it could be soon. So stay tuned for more.